It's a pleasure to be with you. I'd like to start my presentation this morning with a story that perhaps a few of you have heard before. It's about my son Trey. Some years ago, we're in South Texas and we're in our Suburban, and we had a TV in the Suburban at the time, and we're on a bumpy road. Trey's adjusting the TV, and I said, "Not now, son," and he ignored my advice. I warned him a second time, and sure enough, we hit a bump, and his hand goes forward, and the TV comes dangling down from the ceiling. And I said, "Okay, Trey, you're going to have partial responsibility to pay for the repairs of the TV. It's like $400 to fix a TV." And I said, "Trey, your portion is $120. And he said, "Well, okay, Dad, my allowance is $20 a month. I can pay $10 a month for 12 months. And I said, "Let me explain to you productivity of capital and Robinson Crusoe digging clams on the beach by hand. And if he only had a shovel, he could dig so many more clams. And you understand how that makes interest rates a real thing. And so your payments will be $10 a month for 14 months. And he said, "Dad, let me be sure I understand. This is how you make your living, by ripping off America." So that sort of is the way the U.S. Congress looks at banks, apparently, as does Trey. And I explained to Trey that ripping off is actually working out pretty well for him. He had a pretty good lifestyle at the time. And he goes to his mother and complains, and she says, "Well, you can't charge a family member an interest rate." And I said, "Of course you can. If you guys keep up, your next lesson will be points and late fees." So we didn't have to get to that. But the banking regulatory environment, it really, I think, does sort of start with that banks are bad, banks are trying to take advantage of the economy. I just want to cite 3 examples, and I know you're thinking, "Oh my God, how long is Paul going to talk about bank regulation?" Let's try to make this brief. But there are 3 examples, and the first one is the Bank Secrecy Act. So this has changed enormously in the last few years. It was passed in 1970. Enforcement was loose until Dodd-Frank 4 years ago. Our bank, we have 1,300 employees. We have 25 people working on BSA. 4 years ago, we had 5 or 6. What is BSA anyway? The Congress expects banks to detect and prevent money laundering. It works for me. I don't want drug dealers at my bank. I don't want international terrorists at my bank. I'm very happy to have an effort to keep terrorists out of my bank. How much effort should I have? Well, about $3 million a year we're currently spending. We do $325 million a year in revenue. We're spending $3.2 million, more exact. In the last few years, regulatory said, "I know you got a software system that's pretty good, been around a while, seems to be working. You need the newest, latest, greatest. You need more people." What does it mean for customers of our bank? A lot of people that are in cash businesses, we need a lot more information. And many of them say, "Well, you don't need any of this information. I've banked with you for 20 years. I'm honest. I'm fine." If you're in a cash business, if you're Joe's bar, we're going to have a lot more information. If Joe doesn't want to provide it, Joe needs to go find another bank. It's going to be really hard. He can maybe stay ahead of them, but it's all closing down. We recently increased our charges for heavily cash-intensive businesses, $500 a month to maintain an account. It's up from $200. It's well below market. And it's the 25 people I have in the BSA division, the $3.2 million a year, offsets some of that. It's about $1 million of it that we make back, but it still is a huge expense to our bank. And so, again, I don't want money laundering, drug dealers and terrorists at our bank, but the expense of it is pretty brutal. The second part is the stress test. So you've read something about this. Again, the Dodd-Frank Act passed in July of 2010 said no more too big to fail. We're going to monitor these banks so closely, we're going to be sure they can't fail. How are we going to do that? We're going to have a stress test. We're going to give all the banks some parameters. Here's the metrics. Here's what capital. Here's what you should assume for charge-offs on all these different categories of loans. Here's the time frame. And you have to prove to us that over a 5-year stress test period that your capital doesn't drop below a certain level, 5%. We've just started doing that. Most banks are in compliance. A few have had some trouble with it. But it's a significant new burden on banks' capital ratios. A good thing from a taxpayer, from a stability of the industry standpoint, I find it to be very attractive. Dodd-Frank also passed the Consumer Financial Protection Bureau, a whole new agency designed to take care of the little guy from these unscrupulous banks. There's good reasons for a lot of it. Some of the mortgage brokerage activity was egregious and despicable and needed to be reined in, but a lot of good banks are being asked to do a lot of additional information. So Dodd-Frank is passed in 2010, and about 75% of the regulations have been written. They still are working on one that just out this week that I thought you might find interesting is the liquidity. Okay, 400 regs, this is liquidity. Liquidity rules just released, 399 pages. Municipal deposits will not be considered, they're public sector deposits, so the bank won those. Broker deposits, the banks won. Correspondent deposits, we lost, we're gonna assume 100% runoff. This is my personal favorite, cash. Cash is a 63-page rule on cash. It's been determined that cash in the ATM machines is really not cash because that's for operational purposes and we can't count that towards meeting our reserve requirements. Effective date, that gets a bit complicated. There are three categories, banks with over 700 billion, phases in over 3 years, and so forth and so on. 399 pages on liquidity, one of the 400 regulations that we are required to deal with. So when you hear banks complain about the regulatory burden, I mean, they're not just whining. There really is some legitimacy to the effort here. And the slide from our correspondent friends at US Bank on this next page shows the complexity of the network. These are the agencies at the top, and these are the services at the bottom that you provide. So if you don't provide all of these services, you don't have all of these agencies. But if you provide all of these services, like many banks do, then you're going to have 3, 4, or 5 of these agencies. Unfortunately, not all of the agencies interpret the regulations the same way. So you get different advice and different guidance and different mandates from the different agencies. It's really quite complicated and requires a great deal of time and a great deal of patience from bankers. So next time you see your friendly neighborhood banker, feel sorry for him for at least a minute, would you? I was asked to comment a bit on the C&I Lending Perspective, and before I do, I'm chiming in a bit on Rusty's comments on the Fed and interest rates. I'm a branch director. I'm a Houston branch director of the Dallas Federal Reserve Bank. So my job as a branch director is to be your eyes and ears of the Fed out in the market and to talk to my clients and prospective clients about what's happening. So the Fed knows what interest rates are. They have lots of economic data, but what's really happening is sort of what we directors. So I am your window into the Fed if any of you would like to do that, as along with the other Houston directors. I started 6 years ago on the Fed, and I guess like a lot of bankers, I'm sort of skeptical. Is this just a big bureaucracy? How qualified are the people? Is it just a governmental agency that spends a lot of money? Does it really accomplish anything? And so maybe the reason they have us as directors is what's happened in my case is perhaps exactly what they want. Is I've become convinced that the Fed is a really pretty tight ship. The economists are top notch. They're very studious. They deeply study the issues. The Fed presidents, Richard Fisher in particular, our Dallas Fed president, is an outstanding individual in every respect, very thoughtful. I especially like the process. There's 12 member banks. There's 12 voting members. 7 member banks rotate. Washington, the Board of Governors, has 5 permanent seats. They come to meetings. The St. Louis guy says, I think we should raise rates for this reason. He puts forth his argument, and Richard says no, and we have our own separate economists, and there's a meaningful, healthy debate. The purpose of the Fed is to mandate, maximize employment, and to keep inflation under control. And so the intentions of the Fed are genuine and fair and honest. And so the last thing I would say is, along the lines of what Rusty's saying, global inflation is in check. And if you look long term, what would really drive global inflation to increase would be labor primarily. And with the globalization of markets, labor supply is abundant. And so core drivers of inflation look to be very subdued to me. And I would go one step further and say I think there's a good chance that the Fed and other central banks around the world will have engineered a soft landing for our economy and for many others. I mean, they could get it right. Now, is it a chance that the whole thing is spring-loaded and somehow rates will pop? Well, of course, even these great people at the Fed are humans, and we could all get it wrong. But I think they have well-intentioned and I think good communication with other central banks around the world. So I'm optimistic about a smooth landing and kind of like Rusty's point of view there. And looking around Houston, it has never been this good for this long, or at least in the 33 years that I've been here. And that would, of course, lead some of you to, it makes you nervous, right? But I'm actually optimistic. I mean, if you look at the fundamentals of what's happening with the shale plays, I heard Janet Clark at Marathon say recently, in the Eagle Ford, they drilled 12,000 wells. They've got 85,000 more to drill. I mean, that's a lot of work. The Permian is the second largest oil field in the world, second to the Gore Field. There's so many people in the room that know more about energy than I do. I'm going to stop. But the fundamentals of the domestic supply of energy and what that means for Houston and our economy here are a game changer. There is a theory out that, yes, prices will be volatile. Of course they will. We know that. And prices are likely to come down soon. I'm surprised they've stayed up this high. And drilling activity will subside and prices will maybe trickle back up. So this theory of a tighter band, less volatility in the activity is something that, of course, as an optimist, I want to believe, but I think is a credible case and possible. You still have to have a downside scenario. It could get bad for longer. It could be, it's a geologic industry, right? It works in long time cycles. But things look to be pretty healthy from the oil and gas standpoint. And then if you look at the things that have been announced around the ship channel, 125 new projects, 84 billion chemical plant capacity, another 100 billions in announcements. This is over a 5-10 year period. It's just hard to sit here today and not feel pretty good about the outlook for things as we know it now. Shift over to financing, what's happening, terms make sense. People are putting more equity in deals than ever before. Many experienced developers or private equity firms, investment banking firms, they will choose to be over-equitized. And you say, why would they do that? I mean, leverage is a good thing. You're going to jazz your returns with a little more leverage, but you have more risk in that scenario too. We had one real estate developer recently came in and asked us to quote a project two ways, one with 35% equity, one with 45% equity. They chose the 45% equity. They got a lot of money they want to put to work, it's a better rate for them. So it's a little bit of a mind shift from the 80s when it was more like, what's the most that I can borrow on this project kind of mentality. And so this is healthy. Multiples are creeping up, but again, lots of equity in deals. Houston just looks great. So when I look around the economy, very competitive, a lot of great banks looking for earning assets. As now globally, but also in the U.S., loan demand is picking up. We think there may be a little bit of firmness on rates because more banks have more to look at. I know you do a real estate session similar to this, but I was asked to make a few comments. And honestly, multifamily, I mean, it just looks great. We're adding a lot of new units. They're being absorbed. There's better information than ever before. The submarkets, I mean, we know a lot more about what is being brought into the market and what is not. And I hear developers, but also equity. Equity is driving a lot of this, being much more conservative. Same thing for office, a lot of square footage under construction. You see cranes everywhere. It's 67% pre-lease. Much of what is not pre-leased is is right of first refusal space. It's hard to look today and say, oh no, this is, you can see the bust about to happen right there. Not saying things can't turn down, but it looks pretty good. Industrial, much the same story. New space coming on, being absorbed, rents moving up, a balanced market, a lot of good decisions made. It makes me comfortable. With that, I'll turn it over to Cliff.